Hi, good evening and good afternoon. We'll wait for 2, 3 minutes so that more participants can join and then we'll start. Ibrahim, you can hear me? Yeah, Ibrahim, you are on mute.
Yes, I can hear you loud and clear.
Oh, that's good. I think, Ibrahim, we can start. Some people are saying they have not received the link. So I'm sending them, but I think we should start. It's already 5 minutes. Yep. So just to give the recap, everyone, last time. We had the same webinar, the part one of this. We had around 3 to 4 weeks ago, I believe on 26th of April. Yes, on 26th of April, Saturday, we had the similar session, IFRS 15 on construction contract. And due to lengthy topic, we had to wind up in between. And again, we are going to basically complete the remaining portion of the webinar. And thanks to you, to Ibrahim, who basically made it possible for all of us to hear him again on this topic. And due to his busy schedule, still he is giving us the opportunity to complete the topic today. So I can hand over to Ibrahim, and I think we will be able to conclude the webinar today in an hour, because I think just maybe 25 to 30% portion of the webinar is left over, and after that we can have the question answer session as well. Over to you, Ibrahim. Thank you.
Hello everyone. I hope everyone can hear me loud and clear. Okay. So as Salman just introduced me, that we have started this webinar on 26th of April before, right? And
Yeah,
uh,
26. Yeah.
and many of the contestants like the webinar and they want me to continue the webinar from the page where we left. So here we are again. So I will just recap the webinar for the slides which we have already discussed last time. So Salman, I'm going to share my
Yep,
screen
sure.
today. Okay. I hope everyone is able to see my screen.
Yeah, I can see.
Okay, so let's start with a quick recap that I have started a webinar for IFRS 15, which was specifically related to the construction contract. In the start, I have introduced IFRS 15 and what is IFRS 15 and why it is very much important for the construction contracts, against which standards, what are those standards which now are not in use, and ISB has introduced IFRS 15 for all the revenue related contracts other than IFRS 16, other than all the areas which are dealt with other relevant accounting standards like IFRS 16, IS 16, and IFRS 17 insurance, and IFRS 9 as well. Other than that, we then discuss about the five-step models, that there are five-step model introduced by IFRS 15, which allows or which guides everyone, any company, not only construction contract but all the other relevant industry, that whenever they want to understand or get the guidance regarding the revenue recognition, they can go through these five-step model and easily they can understand the accounting based on the provisions of the IFRS 15 standard. So these were the five-step models. Number one was identifying the contract. That first of all, if there is a contract available, then only we can start to understand either when the revenue can be recognized, at what point, and against which performance obligation which revenue is recognized, and what is the measurement criteria for such revenue. So there was the step one is identifying the contract. We need to know the contract should be there, which includes the approval from both the parties. There should be clear rights and payment terms mentioned in the contract. There should be a commercial substance there. There's a probable collection of consideration, like both of the side there should be a consideration agreed into the contract, which confirm this is a contract. And then we also discuss about what is contract modification, what is separate contract, when we treat as a contract as a separate contract, when we treat contract as a modification. I'm just going quickly because this is a recap. We already discussed everything in detail in the last session. Then we have discussed step two, which was very important. I told everyone this is extremely important step whenever you are whenever you are getting the guidance from the IFRS 15 in relation to revenue recognition, that what are the performance obligation under the contract. You need to identify what are the performance obligation, what are the responsibilities, what are the duties, specific obligations which needs to be performed under a specific contract. And you need to understand either this performance obligation is distinct or this is not distinct. And how can you understand that a particular performance obligation is distinct? There is a two-step model which we have discussed in detail and what is the standard saying that what is separately identifiable and what is not separately identifiable. All those items Salman can later on share with you the this presentation so you can understand it again, inshallah. So this was we discussed in step 2, and in step 3 we discussed the determination of transaction price. Like after we understand that what is either the contract is present or not. First, we identify the contract, then we identify the performance obligations under the contract. And the third part is also very important, that what is the transaction price of the contract. Not transaction price is the basic transaction price is the amount of consideration an entity expect to be entitled to in exchange for goods and services that could be affected by the nature, timing, and amount of the consideration. So transaction price is basically the contract amount which a buyer or supplier can expect from the customer in exchange for the performance obligation performed. That could be exchange of goods or services, whatever is agreed. Okay, and in the transaction price, there could be several things which needs to be considered and very important. That is significant financing component. Either there is non-cash benefits, or either there is a consideration which is payable to a customer, any amount. So there are specific methods as well. Significant financing component, I told you, like if there is a consideration which is agreed under the contract, which will be payable after 12 months. This means there is a significant financing component, which then if a consideration that needs to be satisfied, and the period of satisfaction is more than 12 months, then there is a significant financing component which needs to be discounted using the incremental borrowing rate. Again, there is a non-cash benefit we also need to consider. If against a consideration a customer is giving you a land, so on in that case, you need to account it for the fair value of that particular non-cash benefit. And if the fair value is not determinable, then he needs to use the standalone selling price, whatever available at that time. This was very important. And that's what we discussed as well. And there is also we discussed there could be variable consideration which needs to be adjusted in the transaction price at the initial stage of the contract. That variable consideration can be bonuses, rebates, discounts, whatever it is. Like for example, there is a promise under the contract that if the contract is satisfied less than 2 years, then the customer will pay you 10% more of the agreed amount. So this is basically a bonus he will give you. So that bonus, we need to understand that what is the if this condition, the probability of this condition, if the probability of this condition is more than 70%, that is highly probable, then you need to calculate a expected value, that how much percentage you is what is the percentage as per the judgment you think that you'll be able to avail this bonus condition. And based on that, you need to calculate the that variable consideration and need to adjust the transaction price. That's also we have discussed in the last session. And then step 4, also we have discussed the step 4 in extremely detailed manner, that what is the step 4. Step 4 was very important. In step 4 we were allocating the transaction price. Like for example, first we have identified the contract, and and nextly and then we have identified performance obligation under the contract. And in the third stage, we have identified the transaction price. We have considered the significant financing component. We have considered the non-cash benefits. We have considered if there is any concession which is needs to be payable by the supplier. And we have also considered if there are any variable considerations like bonuses, rebates, or discounts. All in the all in these cases, we have agreed what is the transaction price. After we know the performance obligation and we know the transaction price, then it's important step come on then there is an important step next, which is step 4, that is allocation of the transaction price. Here also we have discussed in last session that how we allocate the transaction price as per the standard. We have basically standard is specifically telling us that allocate the transaction price each performance obligation based on the relative standalone selling prices. I explained you everyone that, like for example, you if you have if you know what are your performance obligation, that is ABC, and you know the standalone selling price against those performance obligation, that is ABC, so you can just proportionate the transaction price based on the standalone selling price. Okay, very simple, whether standard selling price of each performance is directly observable or not. Like stand, I prepared a tree here, I'm explaining again so you guys can understand that if for a particular performance obligation under the contract, I have given an example of construction contract that time as well. Like there's a contract to construct a building. In construction of the building, there at the initial stage, first you need to prepare a design, then you need to prepare a blueprint, then you need to perform the interlocking of the building, and then you need to perform a gray structure on the building. So there are separate performance obligation. And if all these performance obligation A, B, C, D, if you have a observable market selling price, you know that this is the selling price of this performance obligation. If it is available, then simply what is your total transaction price in the contract, just proportionate against the selling standalone selling price of such performance obligation. And whenever such performance obligation is satisfied, record the revenue against that performance obligation which you calculated here based on the allocation of transaction price. If no, if you don't have a observable standalone selling price, then standard gives you three approach, that is market assessment approach, expected cost plus margin approach, and the residual approach. Then this means that if you don't have a standalone selling price which is not observable in the market, then you need to estimate the standalone selling price. The best method, which is normally used by the construction industry and in normal practice in the industry, is the market assessment approach. Market assessment approach is very simple. It is the prices and fair value of the goods and services in the market. Like if you don't have a observable standalone selling price in the contract for your particular performance obligation, then you just need to check what is the fair value of such services in the market. And like for example, you from market A you get a fair value of 1 million for particular service. From market B you get the fair value of 1.1 million for a particular service, and for market B you get a selling price of 1.15 million for a particular service. Just average out all these three, and then you can assess this is the market selling price of that particular performance obligation. And then when you have all the standalone selling price that is estimated using a market assessment approach, then you can just allocate the transaction price on proportionate basis on all. Further, if you are not able to collect the fair value of the goods and services, then you can go to expected cost plus margin. Like it is very easy that you know, like for example, this is your performance obligation that prepare a gray structure of the building. Okay, you need to ask your engineer that what is the estimated expected cost of this gray structure. For example, they tell you that the expected cost to build this gray structure is, for example, 100 million Saudi riyals. So you just need to add your 10%, 20%, whatever agreed margin into it, and that consider that amount is your standalone selling price and allocate the transaction price accordingly. The third is the residual approach, which is least used by anyone. That is the total transaction price less the sum of observable standalone selling price. Like for example, you have four performance obligation, from which two is for example two per there is a observable standalone selling price in the contract for two performance obligation, and there is no standalone selling price observable for the other two performance obligations. So what you will do, very simple, like remove or reduce less the sum of observable standalone selling price from the total transaction price, and whatever is left is the residual. You can then allocate that residual value to the remaining performance obligation as a standalone selling price. Okay, and regarding the discount and variable consideration, you need to understand that, for example, there are four performance obligation, and the discount is only applicable to two of them. So first you need to allocate the discount and then adjust the remaining standard selling price when you're using the third approach, that is the residual approach. So this was our last session. The two or three more slides were remaining. Let me go to that. So inshallah, we'll continue from there. Okay. I tried to give you a very brief recap so you can able to inshallah communicate and go along with me. Let's see the the last and the most important step is a step 5, that is recognize revenue. That could be over time or point at a time, point in time basis. Like now we know there is a contract which exists, and then we have also identified that there is ABC performance obligation exist under the contract, and then we have also calculated the transaction price as well. As per the contract, what's the total transaction price after adjusting any variable consideration or any significant financing component, or if there is any non-cash benefit as well. And then we have also done that stage, that is allocation of the transaction price against the observable standalone selling prices. And if this observable standalone selling prices are not available, then we have calculated the standalone selling prices based on the three approaches which is guided by the IFRS 15, that is market assessment approach, residual approach, and the expected cost plus margin approach. Now everything is done. Now there's a time to record the revenue. How you record the revenue? Very simple, very simple. The major difference between the previous accounting standards and the IFRS 15 standard, you can observe that difference in step 5. That is the word which was not used in the previous accounting standard. That is the word that is control. As per IFRS 15 and in the step 5, a performance obligation is satisfied when control transferred to the customer, meaning they can direct its use and obtain substantially all its benefits. Hence, the revenue is recognized. Before you, before you understand that when to recognize the revenue, what is the measurement criteria, you need to understand that is very important. That IFRS 15 is very specifically saying, telling you, it is not telling you that uh, transfer the title deed of a particular good or transfer possession. There, IFRS 15 is not using these words. IFRS 15 is using the word which is control. In any manner, in any manner whatsoever, if there is a circumstances which confirms that a particular performance obligation, that could be a provision of goods or services, again, the circumstances confirm that the control of such goods or services has been transferred to the customer in any manner. The customer is using its benefits. The customer can direct its use and obtain substantially all the benefits. Then this means that the control is transferred, and then you can recognize the revenue. And this is the case in in construction contract. You will find these items in in a big amount of examples. So there are two criteria under step 5. The revenue can be recognized on overtime basis, and revenue can recognize at a point in time basis. Here I have prepared a tree which will guide you that when you can recognize the revenue over time, and when you can recognize the revenue at a point in time basis. In many cases, in construction contracts, overtime basis is a very big debate, that when you can recognize the revenue on overtime basis and when you cannot recognize the revenue on overtime basis. Everything it depends on the terms of the contract. Like first we'll read this table, that performance obligation is satisfied, that is control is transferred over time if any one of the following is met. See, IFRS 15 is telling you any one of the three condition which you can see in your screen, any one. Not, I'm not telling you that all of the conditions needs to be satisfied. If any of these three conditions is satisfied, a customer has a right to record the revenue on overtime basis as per IFRS 15. You'll understand the logic right now. The condition number one is customer simultaneously receives and consumes the benefits. Common in facility maintenance, but rare in large scale construction. What does it mean? Number one is very simple, that customer simultaneously receives and consumes the benefit. Like for example, if a customer asks you to construct a building, okay, simple, construct a building, and you told me, okay, we'll construct the building in 3 years' time. Okay, first we will prepare a gray structure, and then we prepare the finishing, and then we do the painting, and then we do the painting, and then we will hand over. This will be three stages in the contract. So, first of all, you need to understand, either the customer can simultaneously receives and consumes the benefits, receives and consumes the benefit. Need to understand. Here, customer can customer simultaneously receives. Okay, we understand customer is receiving the benefit, but and consume, but they cannot consume the benefit here until he can use that gray structure for rental purposes, which is not possible, right? So the first condition cannot be met until that gray structure can be used by the customer for a rental purposes, which is not possible, right? So first condition cannot be met. However, if the contract was little different, like customer is saying that, okay, after 3 years time, I also want you to give me a facility maintenance services for the next 1 year. Like, after you hand over me the building after 3 years, for the next year, that is the fourth year, I want you to give me facility maintenance services whenever it is required. Okay, so that the facility maintenance is a separate performance obligation, which will be available, or which can only be satisfied after you hand over the building. And when you hand over the building, then customer can easily receives and consumes the benefit, because as per the contract, customer wants you to be available for facility maintenance for the next 1 year. So that is, the condition is satisfied, and you can record the revenue whenever the month is passes after handing over the building, that is after third year. The second condition is create, enhance and asset the customer controls. This is extremely important condition under IFRS 15. Whenever you are thinking to record the revenue over time, see, it applies when the site is on customer owned land and the work is progressively handed over. In our first example, customer has asked us to construct the building on his own land. Own land. This means this condition is satisfied if the customer controls the land, no one else is controlling the land. So at the end, when whatever you are doing in that land is basically giving benefit, giving the control, or transferring the control to the customer. So as per IFRS 15, if this condition is satisfied, you need to record the revenue over time basis, because it's saying IFRS 15 is saying any one condition, any of the one condition is satisfied, you can record the revenue, that is over time basis. Over time basis means that the contract is for 5 years, you can record the revenue not at the end of the contract, but on the stages when you complete such services. How you calculate, I will discuss later on. Okay, so first condition not meet, but second condition meet, record the revenue over time basis. Third is that for example, customer is like there is a first I'll read the condition, then I'll give you the example. There is no alternative use and enforceable right to, and no alternative use and enforceable right to payment for performance completed. Typically, okay, like for example, there's a contract with the customer to construct 20 how 20 villas in a particular land which is not owned by the customer, which is owned by, for example, which is owned by us. A land is owned by loaned by company A, which is constructor. A customer reached to the custom company and asked him to build 20 villas on that land. Okay, 20 villas on that land, and all of the villas should be of this design, this color, this elevation, blah blah blah. All the specification of the construction has been provided by the customer. Okay, so if the customer goes away, you cannot sell these villas to anyone else because there is no alternative use. Okay, those villas were typically constructed for the purposes that needs to be fulfilled by that customer only. And secondly, because of this condition in the terms of the contract, the payment right was enforceable by the supplier, that whenever such milestone will be achieved, supplier has an enforceable right for the payment, which customer cannot breach or which customer cannot cancel. Like for example, if a customer cannot cancel, so in that case, if any this type of condition is filled, even even the even the land is not owned by the customer, the revenue should be recorded on overtime basis because there is no alternative use and there is an enforceable right to payment. Enforceable right to payment can be, the right can be established in any manner. For example, I'll tell you. For example, if there is a clause of penalty under the contract, okay, and the penalty is of huge amount, like 20% or 30% of the total contract value. Okay, like in the contract, it was written after the sign that if any of the party breaches the contract and want to cancel the contract, needs to pay the penalty of 30% of the total contract value. Thus, it's just it's pure judgment call that no one will give you 30% of the penalty amount, which is a full loss of to them. So it is very, very rare chances that customer can withdraw the contract, and that penalty can become an enforceable right to payment for the performance completed, and the customer can use this condition to record the revenue on overtime basis. If none of these conditions is filled, the customer then should record the revenue at a point in time basis. For example, I'll tell you, there is another example for point in time basis. For example, it is very common nowadays. A developer purchased a big land, and then on such a land, the company secured, a developer secured a off plan sale license. That is, off plan sale license. It means that until the project is completed, the project completion time is 2 years. So at the initial start of the contract, a developer can ask the customer if anyone wants to invest in the project or want to purchase the plot. They can give us the advance amount and then give us the installment, monthly installment, and uh, at the end of the 2 years, after the completion of the installment, we will we will sell the or we will hand over the plot to the customer. So in such kind of contract, like we are constructing or we are developing a land, a plot, and we're going to hand over that land parcel to the customer after the completion of his installment, we need to read the contract that particular contract does it have a enforceable right or not, because the land is owned by the supplier himself. So, and if the land is such of nature, if even if the customer breaches the contract, we can sell the land to anyone else because there is no such thing which confirms that there is no alternative use. In such cases, the revenue can only be recognized after the control is transferred to the customer, that is handover, or transferring the title deed of that particular land to the customer. Okay, so the control cannot be completed before the delivery of such service, before the delivery of such land. In that case, only point in time revenue can be recorded. Now, lastly, I need to explain you that when you decided to record the revenue on overtime basis, there are two methods which can be used. That is output method, and the other one is input method. Both methods are acceptable. In general practice, the construction industry is using input method, and but also I have seen and I have used output method as well in construction industry as well. What are these methods? Input method means that how much, that for example your total estimated cost to complete a particular project is 100 million estimated cost, I mean. Okay, and you have actually input the cost, actually incurred the cost till after 3 months is 30 million Saudi riyals. So this is input, what you input in the project, that is you incurred actual 30 million and the expected estimated cost of the project is 100 million. So 30 divided by 100 is 30%. This means at the end of third month, your your progress for the project is 30% completed. So you just need to multiply the 30% to your estimated revenue, whatever it is, and that amount should be recorded as revenue after the end of 3 months. And also and the cost will be the actual incurred cost as is. Secondly, what is output method? Output method is basically, generally the output method is basically the percentage of completion, the percentage which is confirmed by the third party valuer, third party quantity surveyor, an engineer, accredited quantity surveyor who has been, you can say, who has been licensed by the relevant authority, who can go to the project site and check that what projects mean to be, and after 3 months how much the progress has been done. Like for example, there needs to be 20 pipelines needs to be installed and 10 pipelines installed, so the pipeline is 50% complete, blah blah blah, all these several milestones. On the basis of several milestones, he estimated the percentage as 40%. So this is based on output which he saw. So that percentage is confirmed by a third party quantity surveyor, which is what we can do. We can use just use this percentage and multiply to our estimated revenue and estimated cost and calculate the revenue and cost accordingly. Now, like for example, you have actually incurred cost 30 million, and as per the output percentage, you need to record the cost 40 million because of the 40%. So 10 million difference needs to be recorded as accrual, and vice versa. If you have actually incurred 30% and as per output method the percentage is 20%, so the 10% which you have extra incurred is your future fulfilling cost, that needs to be recorded under contract asset. I hope I explained you the I have explained you the major, for all the five steps. And if there is any questions regarding anything, you can ask me. The other slides are basically all cost to fulfill and cost to obtain, which we have already discussed in the last session during our discussion. You can whenever Salman will share you the presentation, you can ask him, and he will share the presentation, so it will be easy for everyone to understand. So if there is any question, please let me know. Over to you, Salman. If you want to share the screen, you can share the screen right now.
Thank you so much, Ibrahim. I think we'll ask for the Q&As. So the
You
floor
want
is
to share
open
the
for
screen, you can
everyone.
share the screen, huh? Okay.
It's okay. Yeah, your screen is fine. Just let's see if anyone has a question.
Okay.
So you can raise your hand or you can type the question. So no one has any questions. Please raise your hand. Okay, so in Q&A. So the question is, can you please repeat the contract asset?
Why I can repeat the contract asset? Who is asking the question?
Sama.
Okay. Okay, Osama, contract asset. Let me tell you contract asset as per IFRS 15. See, as per IFRS 15, contract asset can be unbilled revenue and can be a future fulfilling cost to contract. Okay, what does it mean? For example, you will build. For example, there is as per the contract, you will bill to the customer. You will bill to the customer based on the milestones achieved. Okay, there is a milestone number one, that is completion of first floor. There's a milestone second, there's a completion of second floor. Okay, and if you are using for example input method, if you are using input method, this means that you calculate the percentages based on the actual cost incurred. And for example, your percentage is 30%. Okay, your uh, your percentage is 30%. And as per the contract, the you can only invoice to the customer when milestone is achieved, that is completion of first floor. So the first floor is not complete, but you are billing to the customer based on your and but no, sorry, the first, you are not billing to the customer because the first floor is not complete, but you are recording the revenue because of input method, that is 30% in your books. So how you will record the revenue? That is revenue credit and unbilled revenue debit, because you can only bill the revenue, bill the invoice to customer as per the contract when the first floor is completed. But you are recording the revenue as per the IFRS 15, that is on input method. In this case, all the unbilled revenue is recorded under a term that is contract asset by the nature as defined by IFRS 15. On the other hand, for example, you are using output method, that the percentage is confirmed by a third party. When the percentage is confirmed by a third party, for example, a percentage is confirmed by a third party, that is 30%, for example. Okay, and you have actually incurred the cost, that is 40%. So when you record the actual cost, how you will record? Like for example, you have incurred 40 million, but you can only record as a cost, that is 30 million. So cost will be debit as 30 million, bank will be credit as 40 million, and the remaining 10 million which you have also incurred, but because of output method you cannot record it as cost. So it is defined by the standard as a cost for a future fulfillment of a contract. Cost to fulfill the contract, cost to fulfill a future contract, which is also recorded as a contract asset, like an advance cost, you can say. So this is a contract asset as per IFRS 15. I hope I answer you.
Okay, yes. Yeah,
You're
we
welcome,
received
Sama.
the answer.
If there is
Okay.
no more question, we can wind up, Salman. No problem.
Yeah. So I think there is no more question, and our topic is also wind up. And thank you so much, Ibrahim, for your valuable contribution towards the members of the institute. And thank you so much, everyone, for joining this evening. We'll be in touch with you again um, for the upcoming webinars soon. Thank you.
Thank
Thank
you.
you so much. Assalamu alaikum.
Alaikum assalam.